FI, financial independence, index funds, buy and hold, and my all-time favorite, time in the market beats timing the market. That idea that investing can be simple, and in fact should be simple, completely changed my life. Welcome to FI Study Room, where we learn and achieve financial independence together. If you are ready to break free from the 9 to 5 and take control of your time, this is the right place. Hey friends, welcome back to FI Study Room, where we talk about money, mindset, and making life simpler one index fund at a time. I'm your host PJ, and today we're going back to where it all began. That's right. I reread the very first personal finance book that kickstarted my journey to financial independence. It introduced me to some big ideas like FI, financial independence, index funds, buy and hold, and my all-time favorite, time in the market beats timing the market. Seriously, if I had $1 every time I quoted that, I would be financially independent by now. Anyway, 5 years later, I picked it up again, and honestly, it still hits, especially after everything that we have lived through, from pandemics to wild inflations to everybody suddenly becoming a day trader, and how the stock market tanked recently. So let's get into it. The book is The Simple Path to Wealth by J.L. Collins. Some of you probably know it. It started as a series of letters J.L. wrote to his daughter, explaining how to invest simply, effectively, and with peace of mind. That idea that investing can be simple, and in fact should be simple, completely changed my life. It just felt like somebody handed me the permission to ignore the chaos and just chill. Honestly, I've applied that principle simplicity across all the other areas of my life too. I really don't like overcomplicating things. So the idea that I didn't need 20 stocks, I didn't need to handpick my stocks, and I don't have 3 real estate partnerships, and to buy the dip every Tuesday, it's such a relief for me. Let me break it down, a few core takeaways that I still live by. Number 1 rule: save 50% of what you make. These are my favorite lessons from the book. The safe rate is the king in FI. If you can save half of your income, you're on a fast track to freedom. Me, I actually have always had a high saving rate, not really because I am super frugal, it's just because I honestly just don't need that much. I mean, I like good coffee, I like clean spreadsheets, but I actually don't really need a Tesla to feel good. Number 2, avoid debt. Debt is like reverse investing. It's like you're giving away your future money. We've actually paid off all our car loans, and that really felt amazing. One less thing to worry about and more money flowing into the investment every month. And third rule, index funds are everything. Let me say it louder for the people in the back. I don't pick stocks. Why? It's because I'm not Warren Buffett, and neither are you, unless you are. If you're listening, thanks for tuning in. Stats show that simple index funds outperform around 82% of managed funds over time. Why try to beat the market when you can beat the market? I think I heard about index fund the first time from this book. I didn't really know what it is when I just started. And this book really taught me about how powerful index fund is. A lot of people say that index funds are like dream investment for lazy people. But is it really? Let's face the reality. Let's just say that you spend a lot of the time studying charts, following the news, and doing all the research. Can you really outperform index funds? And for how long? Most actively managed mutual funds don't even come closer to the return that index funds has got to. What is index fund? The S&P 500, which is basically a snapshot of the 500 biggest companies in the US. And in the past, it has returned an average of around 10% annually over the last century. Can you imagine that? Over the last century, think about the compounding effect. That includes wars, recessions, pandemics, you name it. And thinking about the managed fund mutual funds, look at the numbers. Do they even come closer to that? Study from Vanguard show that about 80 to 90% of actively managed funds underperform their benchmark over a 10 to 15-year period. And why is that so? Number one reason, those managed funds usually come at a higher cost. All those fees eat away the returns. And managers also make emotional decisions. And lastly, they always try to time the market. Most probably get it wrong. Index funds don't try to outsmart anyone. They just ride the wave of capitalism. I guess the reason that a lot of people don't really like it, because index funds has average return. Nobody wants to be an average person. And everybody thinks that you outsmart other people. And then you can be that 10 to 20% of people who are able to pick stocks and outperform. I know I am not. So I will happily take what index funds has to offer. Also, index funds are actually tax efficient. Since there is low turnover, you are not triggering capital gains taxes constantly like you would with active trading. To top it off, they are actually super simple. If you want to invest in the whole US stock market, just buy VTI, one clicker, done. This simplicity has given me so much peace of mind, while others are stressing about earnings report and the next big IPO. And for me, I'm just out there, drinking coffee and forgetting my brokerage password. Another great lesson that I learned from the book is about asset allocation. So yes, the book is talking about investing all your money in index fund and then don't touch it and just chill. But does things change when you are at different life stage? So J.L. Collins actually breaking it down really simply. And it almost feels like cheating. Like, why aren't we taught this in school? How can we think about different allocation strategies when we're at different stage? So here is how the author puts it. If you are building wealth, so basically you are in wealth accumulation phase, go 100% index fund. That's it. Simple. And one fund to rule them all. So VTI or something like it, and just keep throwing money at it like you are feeding a very hungry and productive pet. The strategy works because you've got time on your side. The market will go up and down, and over decades, it always trends up. So you stay in, don't flinch, and just let compound growth do its magic. There's another phase that you might be in after you accumulate enough wealth. So you might be near or in your retirement. At that time, you're in the wealth preservation phase. It's time to shift to something like 75% index fund, 20% bonds, 5% cash. This is one example that the author gave in the book. So that's essentially how they do it in their family. This mix gives you some growth, some cushion, some liquidity. It's like diversifying your superpowers. Stocks are your strengths, bonds are your defense, and cash, this is your escape plan when life throws a curveball. There are three tools that were talked about in the book: stocks, bonds, and cash. And let's look at them individually. For stocks, the author specifically talk about index funds. These are your growth engine. They're where your wealth builds over time. It's low cost. If you choose, for example, Vanguard, VTI, it's diversified and doesn't really try to outsmart the market. It is the market. There's bonds. They're the steady ones. They're like the friend who doesn't really party but always show up when you need them. So they provide income and lower risk. It's going to be super helpful in your preservation phase. Lastly, it's the cash. It's for emergencies, opportunities, or just peace of mind. You always need something in your bank account whenever you need it in the life. It doesn't really grow that much, but sometimes that's not the point. It's about having the option to do things whenever you want to. Okay, here's the first question. But what if market crashes? This happens all the time. Recently, the stock market tanked. And every day waking up, I saw so many different media. Everybody is talking about how market has crashed and how things will just go bad and will never get better and how you should just quickly sell everything. But this book taught me a powerful mindset. When the market crashes, do nothing. Do not panic. Do not sell. Just ride it through. In the past 50 years, every major crash has been followed by recovery. And usually, those who just held on recovered faster than those who jumped ship. My strategy is bulletproof for people like me because I'm just excellent at forgetting the passwords to my investment accounts. No logging in, no quick tweaking, so just let it ride. Okay, what did we learn about housing from the book? I think this one is really relevant to people who live in the Bay Area because the housing price here is just through the roof. One thing I love from the book that really stuck with me is that buy the least house you need, not the most house you can afford. That's such a mindset shift. Most people treat home buying like a flex, but it should be about freedom. I've invested in real estate over the years, but haven't bought a primary home yet. Still figuring that part out. After reading the book, I start to think about my asset allocation a bit more and how do I arrange all the money that I have right now. So right now, overall, I have about 44% of my net worth in stocks. They're basically all in VTI or something similar to that. And I have another 44% in my home equity. So these are all the asset, all the net worth from my investment properties. And I have around 12% left for the cash. One thing that I have been thinking is it really the optimal allocation? Should I do something differently about this? Am I putting too much money in the investment property equity? Are they growing as fast as stocks? Or should I rebalance them at some point? Two things that I've been thinking very actively is one, I know that there are some bonds that are offering tax benefits that for some bonds, like you don't have to pay state tax. And maybe those are the things to buy with my cash. Another thing is maybe I just should move some of my cash to VTI because I don't really need that much for my daily life. And they can be really helpful if they're in the stock market. I actually started tracking my net worth after I read the book the first time. Because how do you manage your money if you don't know where your money is? It has been really, really helpful and really inspiring to see how your money grows over time. I've been using Empower. It is a really strong and powerful online platform where you can link all your accounts. Even you can link your partner's accounts, all the bank accounts, all the mortgage, all the credit card details, all the investment brokerage accounts, everything there. And every month or every day, you will be able to track real time how your money has been growing. And it's really like the Google Analytics of my financial life. And it offers extreme transparency, especially for a family. And what my partner and I do all the time, or once in a while, is that we will sit together and look at the trend and just try to get some learnings from it. Or we will look at our credit card expenses. And it also offers different breakdowns, so you will be able to see how much you spend compared to last month in which category. This has been really, really helpful. So I highly recommend people who haven't tried it, just go there, just try it, and then see how you feel about the tool. This is everything we have for today. A quick recap. Rereading The Simple Path to Wealth reminded me that basics work. They worked 5 years ago. They work today. And I believe they will still work 20 years from now. So if you're starting out or feeling overwhelmed, remember this. You can keep it simple. Save more than you spend and invest in the market. And lastly, forget your password. That's it for today's episode of FI Study Room. If you enjoyed this, I'd love if you share this with a friend or left a review. Until next time, stay curious, stay chill, and let's keep buying those index funds.